welcome back. You're watching Stockwatch with me, Julieta Televi, and joining me to take your stock-related questions this evening are Graeme Korner from Korner Perspective and Reddy from All Weather Capital. If you'd like to send questions, please do email stockwatch@bdtv.co.za or SMS 41392. Graeme and Chris, good evening to you both. Graeme, if I may start with you tonight. It was a sort of a soggy day on the JSE today. We closed slightly weaker. The rand was a bit weaker. There wasn't a hell of a lot of news flow. As I was saying before we went on air, the most exciting thing was Awando, and I'm not sure if anyone owns shares in Awando anymore. So, but there's quite a lot to digest, namely the direction of, or what's going to happen with interest rates. There's quite a lot of decisions coming up, and there's still a lot of US earnings to plow through.
Yeah, absolutely right. I think our market, as you say, was soggy. In fact, if you look at it through the day, it just kind of just drifted away, rusted away. Probably in spite of a slightly weaker rand, as you say, ending the day down. You would have expected the rand to give us probably about a 1% shield, but European markets down a little bit more than us. So yeah, I think it's just, as you say, Julieta, markets are trying to sort of figure out where the next move is, at what pace, when will the Fed start and how aggressive will they be? We've got quite a few rate announcements out of some of the bigger central banks this week and obviously in the next couple of weeks. Yeah, so I think everybody's kind of a little on tenterhooks from what I can see. The Nasdaq down about 8% from its best a couple of weeks ago. Yeah, so there's just a little bit of anxiety and, of course, big week from an earnings point of view. So I think maybe people just wanting to be a little bit more circumspect than maybe they have been for much of 2024 and probably late 2023. Yeah. I'm talking globally. Yeah. So South Africans have been very, very pensive for quite a while.
Yeah. Chris, the FT was talking about the mega caps in the States being now, a lot of them in correction territory. So that's officially where you are down 10% or more, the biggest ones being NVIDIA and Tesla. It seems scary, but it's probably just a very healthy pullback. Or how do you view what you've seen in some of those big tech share prices in the last couple of weeks?
So I think if you look at the mega caps that reported last week, the beats that they had, for those that actually beat the market, the beats weren't as big as what they were in the past. So there is a view that a lot of these shares are priced for perfection. We did see a clear rotation out of AI shares last week into like the Russell 2000 and also other more defensive sectors like energy, healthcare, telcos and the likes, utilities as well. So as Graeme was mentioning, it is quite a big week for the rest of the week. Tomorrow we've got Microsoft reporting, and then Wednesday we've got Meta reporting, and then Thursday is a big one with Amazon, Apple, and Intel. So whether the AI rally can continue, it will come down to these next 3 days. I mean, as you mentioned on the JSE as well, very light volumes, only just under 15 billion traded, with about 4 billion of that in the end of day auction. So super light volumes. Some fairly large moves in the likes of Absa. We saw some of the Sunday Times articles reporting on the bank over the weekend, probably weighed on the share, and then some disparate moves in some of the other resource names as well.
So while we digest what's happening in the US, I had a very interesting chat with John Bickard from 91, and he runs the Value Fund. And often he is in a contrarian position. And I don't necessarily think it's a deliberately contrarian position, but it's a position that focuses on the relative value of share prices. And they were talking about how bullish they are on South Africa, and that South Africa they would much rather buy than the S&P 500. Graeme, do you think, is that a view that you share? And he was talking, along the lines of valuations of companies. So Chris mentioned Absa. Absa at what, 163 Rand, or maybe a little bit less today, is still trading well below the PE levels it was during the height of Ramaphoria. And it just sunk really so. He was so low. So he was saying, there is room for distinct improvement. And also then, if you consider that we've had no load shedding, things seem to be looking up. So is that a thesis that you would subscribe to, and actually maybe you should do a bit of portfolio rotation just as a retail investor and sell out of your S&P 500s or your Nasdaq shares?
I'm smiling because I agree 100% with John. I mean, if you look at, Chris was just talking about, Microsoft as an example. I mean, Microsoft's a multiple of over 40, great business, doing very well. But, the markets have just pushed these things too far. And the techs and the financials particularly, maybe a little bit of healthcare, have just become so dominant there that, to me, you don't want to call markets bursting. I don't think that's necessarily what we're looking at, but it's kind of it needs to correct over a season, let's call it. And either you're going to get a little bit of a burst. You've already seen it in some of the big techs, or it could just be a slow puncture. So people get progressively more realistic, and those share prices maybe slip a little bit, but the earnings do hopefully over the next few years come through. And then you start moving into slightly more sensible valuations. But I mean, you could fit probably 5 South African local economy stocks. We hold lots of them for our clients. You could probably fit 5 of them into the multiple of the average tech play in America. So
Yeah.
you could put a lot of 6, 7, 8 PEs into a 40. So yeah, I would agree with that. And I think also I've said this before that everything gets lumped into this AI basket, but they're not all obvious AI beneficiaries, and they're not all. Although Microsoft's a great business, it's not going to give you NVIDIA kind of earnings growth, if I could put it that way, over the next while. So I would agree 100% with John. I think South African equities are as cheap as they've been in a very long time. In spite of quite a few of them having recovered quite nicely, they're still very, very cheap if you look over a 10-year or 20-year horizon.
Yeah. Chris, you were also nodding. I mean, I suppose, so your thoughts on how much we could improve from this point. Also, do you think it'll take quite a bit of time before people catch on? And often you catch on just as a new trend is well established, shall I say, not at the beginning of a trend.
I mean, a couple of points, right? I think if you look at over the past couple of years, there have been some severe headwinds facing SA Inc. shares. The first one being the change in Regulation 28, where many of the local large managers were basically moving more and more of their exposure offshore. So you had this continuous selling down on the SA Inc. shares. We had severe load shedding back end of 2022, early 2023. That also placed an overhang on many of our shares, retailers and the likes, depressed consumer confidence. I think post the election outcome, we are seeing some good improvements coming through on the infrastructure side. I mean, we've also gone almost, 4 months now without load shedding. So I just think we're coming off such a low base. We don't really need that much marginal improvements to actually start getting the economy going again. We saw some reports about if we can just sort out Transnet and the ports and the rail network, plus sort out keep Eskom going as it is, you're probably looking at a 2 to 3% impact on just GDP alone on just those 2 initiatives. And then looking into the back end of this year, there's some good tailwinds with regards to some rate cuts coming through. That should be supportive for our retailers. You've also got the 2-pot system as well, which kicks off in September. So some additional support coming through from a disposable income point of view, which we think should support companies like Mr. Price, Pepco, Usave, ShopRite, with regards to some of the consumer spend, like what we saw with the COVID grants in the prior period.
Yeah.
So agree with John and what Graeme is saying as well. There's still significant upside into SA Inc. Exposure.
Right. Please do carry on sending your questions. Hopefully we can get to them in the second half of the show, and I do apologize that we haven't yet, given a few technical challenges. Just on the stocks that did well, and we've had this question before, but I'll ask it again, out of our power crisis, so renewable energy companies that position themselves accordingly, something like Reunert, for example, do you think they are going to now take a bit of a back step, or they won't hold the same sort of appeal as they might have done a year ago? Is that going to sort of hammer their prospects? Graeme, do you think that's a possibility, or is there enough of a rest of business to counter for maybe not such a huge stampede into renewable energy as there might have been in 2023?
Well, I would argue companies like Reunert have got quite a few other arrows in the quiver, so to speak. And if there's a lot of spend on electrical infrastructure, for example, then it'll, I would say, more than make up for that. So I would argue that these are well balanced, well diversified businesses, and the net pickup, if SA Inc. starts going firmer, I think will continue. Also, although load shedding is not the issue that it was, I think a lot of households, a lot of corporates have made that decision. You've seen already a lot of companies made massive strides in almost de-risking themselves completely from Eskom. And I think that trend will continue. So it's not like Eskom is fixed and suddenly everything, the taps get closed. But I would argue that a company like Roynet will probably be a net beneficiary if SA Inc. does better.
Yeah. Sorry, we pulled up the charts of Roynet, which is very easily confused with Roynet, especially if you're not that familiar with the market. The share code is RLO for the technical crew. Chris, your thoughts on Roynet, or indeed any other companies that did obviously well last year? And I'm also thinking of, a company like Grindrod Limited, for example. You saw a lot of volumes going through the Maputo port. I suspect you're still seeing that, but they definitely caught the market's interest last year, and I kind of wonder if that's going to tail off quite a bit this year.
In the case of Roynet, I think what we are seeing with some of the other global infrastructure-led firms, we are just concerned in terms of just the level of inventory that they've currently got, and then what happens with the rate of growth going forward from here, because we do think that to an extent it has to be tapering off. The corporates that wanted to put in place backup solutions and stuff have already done it, and I think for many of the consumers as well, they've also done those backup inverter panels, batteries type of setups. So I'm just not sure if that rate of growth continues from this point onwards. On Grindrod's case, I think it's slightly different. I think if we can sort out some of the local ports, there's still a case to be made that they can still push through volumes on that side. There's still a strong pipeline on the Maputo side as well. So I think the tailwinds are a bit longer in Grindrod's case. And as we've seen in the past with Imperial as well, there's always the side potential as well for potential corporate activity as well, given how cheap some of our industrial shares are as well. So there's some optionality on the Grindrod side.
Okay. I feel like we've had a CrowdStrike moment. So I am like the lady at the checkout counter in maybe LAX or Gatwick, and there's a lot of angry people wanting to board a flight, and I can't help them. And so I'm very sorry that we are not able to take questions, and I can't really see what's going on. So, Graeme, one of the issues one of the questions that we got a couple of weeks ago was on whether or not this was going to be the quarter for gold shares. And there was quite a lot of froth about the gold price a couple of weeks ago. It's sort of diminished a bit. I wonder if you think that was a very flash in the pan, as it were, sort of trade.
Juliet, I'm the last person to ask about gold. Quite frankly, I think I can see a case to make for gold right now. But having said that, whether the gold shares are actually going to make you money or not is another question, because all the planets can line up and then the grades are bad, or or weather or coal or something. So I'll hospital pass that to Chris.
I'm sensing Chris is going to do exactly the same thing and bounce it back to me.
No, look. So on the gold shares, I think to Graeme's point, they've had a phenomenal year-to-date performance. If you just look at Harmony and Anglo Gold, right, they're both up close to about 40%. The key thing that we're watching on the gold shares is just how deeply long the market is in gold shares. So it does look like it's a deeply consensus position. Many are saying, given the heightened geopolitical risk, we are likely to see also rate cuts coming out of the US, so maybe dollar weakness going forward, which should be supportive for these safe haven players like gold, Bitcoin, and the likes. We are just a bit concerned in terms of just how much of that goodness is already being priced into these shares. I think investor positioning is quite crucial as well, because if most of the market is already long, you've got speculators also quite long gold. Who's going to be the marginal buyer that's going to come in to support these shares going forward? I think part of that unwind is actually what we've been seeing over the past couple of days. Even in a US risk-off environment, gold was not the safe haven to be going into last week. So I think most are already long gold exposure at the moment.
Yeah. Talking about the US, there wasn't a hell of a lot of company news today. As I said, Awando was probably the most striking thing on the JSE. Internationally, it was McDonald's came out with results. and they posted the first drop in global sales since 2020. I mean, some of the stats were quite interesting. And they talked about, I think it was the CEO of McDonald's, talking about the average cost of a Big Mac is up 27% since 2019. So it's a graphic illustration of the cost of living crisis that we have all experienced everywhere, UK, US, South Africa. Graeme, what is your sense or thinking about kind of consumer-related shares in light of maybe some of the results that are coming out at the moment?
Well, I think it's telling us what we know. And I mean, in South Africa, we obviously have had it, but arguably we used to inflation at 5 or 6%. But, in places like the UK, they really aren't used to it. And then generally the wages don't keep up. So I think in places like the UK particularly, it's really tough. And I think generally companies have been battling to fully pass on those cost increases, and it's maybe more a case of the tide has been coming in. But I personally am a little bit anxious that they're going to really battle to pass that on. My sense is that everybody is celebrating inflation rightly easing back. If you look in the US, let's call it under 3%, but it's quite sticky, and the question is whether wage growth is actually going to keep pace with that. So I would be quite wary of just betting on the fact that these US retailers, consumer-related companies are going to continue clocking in, mid-single digits to early double digits earnings growth, with a little bit of, a little bit in volume, especially those obviously that are still growing their footprint in other regions. So I'm a little bit worried. I think the consumer globally is actually under quite a lot of pressure. And they may get some reprieve, for example, in the US from an interest rate point of view. But I think consumers out there are in many parts of the world, are very indebted. And this food inflation, for example, energy inflation, is a big deal. I think we've almost ignored it, but I believe it's going to become a really big factor, and it's going to hurt consumer stocks quite hard. And then you think more about, maybe FMCG, like the P&Gs and the Reckitt Benckises and those guys. But even the big retailers in the US, I think, are going to battle, especially if there's no technology-driven earnings growth.
Yeah. Chris, what's your take? I mean, interestingly enough, McDonald's is actually up 4% today. You didn't really expect that to happen.
I think one of the key points that we're also watching is just what's happening with the state of the Chinese consumer as well. So I think many of the US global companies, so the likes of take Nike, for example, right? Or even if you look at the luxury side, LVMH, Richemont, the likes, they all showed quite soft China numbers. And while the US was able to compensate for part of that, it wasn't enough to cover what's happening in China, slowing down in Europe as well. So that is one of the factors to monitor. I mean, if you just look, for example, Ford missed their earnings by about 20 US cents last week. They produced about 42 cents. The market was expecting 62. The share was down 18%.
Jeez, yeah.
So this speaks about how sentiment is at the moment. If you do miss, there's quite a bit of downside to go on these shares. And I mean, we had the Chinese third plenum as well recently. Not much has come out of that. So I think everybody's now looking forward to the Politburo for any further stimulus measures. But the Chinese consumer is still under pressure, which is now coming into impact some of the global consumer shares that have got exposure into China. And then pressures on the US consumer as well, which is now building up.
What about the luxury goods companies? I did speak about it last week. You're starting to see the cracks in the LVMHs of the world. And I wonder if those are also the next shares to get it in the neck. Graeme?
Yeah, I think so. I think the valuations are quite stretched. And I mean, what we were talking about now, sort of as the doomsday prophets, is the fact that things are getting quite tough. We're not entirely sure what GDP growth is going to look like at the moment. The US is in the perfect Goldilocks scenario. Inflation's moderating, employment is holding steady, GDP growth surprised in the last quarter. But I do think we're starting to run the engine a little bit on empty. And I think to Chris's point, we are quite vulnerable to China disappointing, because I would argue if you take an LVMH or a Richemont, for example, China was kind of not doing or playing its part as much as it used to. And you found other regions like the Americas, for example, Europe, starting to look better. I worry that if those come in for a bit of a soft economic landing and China's not firing on all cylinders, you could have disappointment, particularly because the valuations are quite stretched.
Chris, you're nodding vociferously there. And I suppose for local investors, Richemont is, the company under fire.
I agree. I mean, look, Richemont's got about just over 30% exposure into China. You got to add a bit more for some of the European sales as well for the Chinese tourist that buys outside of China. So I think you have to be quite selective. I mean, companies like Hermes actually performed quite well last week. So there is some element to say pay up for quality, but you are paying up almost 45 times multiples for Hermes. Similarly for Ferrari as well. So maybe those are your defensive plays in the luxury sector, but you're not getting it cheap. And then other companies like LVMH, Richemont, even Kering had a tough last week as well, as they downgraded their Gucci numbers, which is still taking a bit more longer to turn Gucci around. That being said, though, I mean, there are some companies in the luxury sector that is still offering value from our numbers. I mean, you can basically buy something like Porsche at a 13 times multiple. Now that's probably a quarter of what you're paying for something like Ferrari. Yes, I'm not saying Porsche is the same as Ferrari, but it's still a luxury play in that supercar segment.
Yeah, I mean, I was going to say, is Porsche a luxury goods group or is it a car company? Whereas Ferrari seems very definitely a luxury goods company, not a car company.
Absolutely. So Ferrari, you're selling a fraction of the units of what you'd be doing at Porsche's 250,000 units. That being said, though, you are paying a quarter of the multiple of Ferrari. So I think at the upper end, you are competing. If you're looking at your 911 turbos and the likes, you're competing with your Ferraris. But we're just saying that the level of that discount between Porsche and Ferrari is too wide at the current levels. And you also, I think you're getting Porsche at the low of the cycle, just given the amount of new models that they are rolling out in 2024, 2025. So production numbers are a bit low currently.
Just speaking about car companies, with the, I suppose, pressure on electric vehicle companies, is there a bit of a glimmer of light for PGMs? So for the PGM prices and also for the PGM firms? Graeme, do you think that's maybe kind of a trade for the rest of the year?
Yeah, well, I think the thing that's puzzling me is we're hearing that some of the PGMs are in deficit and yet the prices aren't moving. So it is a case of 1 + 1 is not equal to 2 for me at the moment. But I think there's another angle to this as well, and that is that everybody is assuming that it's EV or NICs, but there are other technologies that are probably quite positive for PGMs, and of course the PGM market is still, Russia is still an important component, although banned, let's call it. So I think the medium-term outlook is actually looking a lot better. And Julieta, you've seen all the South African producers basically cutting back, curtailing operations, retrenching. So if you're already in deficit and demand picks up ever so slightly and the supply over the next year or two is going to diminish, you could be in a very interesting PGM space, particularly because of Russian supply coming offline. So yeah, but it's not for sissies, widows or orphans. It's
never is. Chris, very quick comment for me on the PGMs before I get to your stock picks, and apologies once again about the questions this evening.
I agree that there's definitely a play for PGMs in this market. If you look at all the companies that have reported from an OEM perspective, Ford, Porsche, they've all, Tesla as well, they've all pulled back their numbers in terms of projected EV sales. And you can see the market tilting more towards the hybrid model, which actually supports demand for PGMs going forward. Yeah. So we think that there's a support level over there.
Okay.
Agree.
Chris, sticking with you, what's your stock pick this evening?
My stock pick this evening, we're keeping it local. So in the theme of SA Inc. shares, I'm choosing Remgro. We just feel that the discount to NAV of almost close to 45% is as wide as what it's been in the past. I think if you look at the underlying investments as well, you all have got exposure into an improving SA outlook. So if you look at the underlyings in financials, industrials, infrastructure, and even some of the consumer and healthcare shares, we all think that you're going to get some good tailwinds coming through for Remgro going forward. There've been some good progress with regards to unlocking that discount. We saw the momentum placement a few weeks ago. We think that all these use of proceeds can actually go into supporting a buyback, which will then also be quite helpful in terms of total shareholder return to investors. I know we're also waiting for the outcome of Comcom as well with regards to CIVH and Vodacom. That could also be a good supportive deal as well for Remgro. Apart from all of those things, the underlying investments as well are all performing quite well as well. If you just look at Mediclinic, Outsurance, Discovery, and the like. So that's our pick.
Okay.
Yeah,
let's hope that discount narrows. Graeme, how about you?
Very similar theme. Pretty much what Chris said times 2. But I'm going to go with African Rainbow Capital, which is kind of the new NAV kid. Interesting assets, also very much, SA Inc. oriented, but some interesting assets outside, particularly Time Global. Discount is even a little bit better, I think. We'll see in a few weeks' time. But yeah, I mean, to me, there's a really exciting portfolio. Discount of call it about 50%, maybe it's slightly under that, for some really, really interesting assets and quite a lot of growth profile in that. So, I'm always intrigued. A company with whatever it is, a 14 billion rand or 12 billion rand market cap. I mean, there are times where there's like a few thousand on the bid and a few thousand on the offer, and I think that creates opportunities for private clients.
Yeah.
So, I would add African Rainbow Capital at these levels.
And clearly there's a buy out there because the share price has rallied quite nicely since its lows in April. So, yes, long may it last. So we'll have to leave it there. And thank you very much for helping me weather the show. And I'm really sorry to our viewers that we didn't manage to take your questions this evening, but I'm sure we will get to those tomorrow night. Graeme Korner is from Korner Perspective and Chris Reddy is from All Weather Capital. Up next, we have The Close. Stay with us. Thank you.